Hey guys, welcome back to the Mastermind Trader, and in this video I am going to be sharing with you my trading strategy. Now I'll walk you through the first things that I do when I hit the markets, how I read the data, and how I use fundamental and technical analysis to actually place the trade. Now let's have a real talk here. I am not saying that my trading strategy is foolproof, far from it. I only really have about a 40% win rate, but here's the thing, right? My risk to reward ratio is 1-3 or 1-4. So whenever I am placing a trade, I am looking to risk around $100 with the aim of making $400 or $300. So in the end, I am being profitable. Enough chit chat, let's dive straight into it and I'll show you exactly how I trade. Okay guys, so here is my trading strategy. Now the first thing that I like to do is go onto the daily time frame, right? And in there, I am looking to get a daily bias. So am I looking for buys or am I looking for sells? Because every day is going to be different and it will depend on what the market is going to be doing. Essentially, I want to know whether in the trend we are bullish or we are bearish. So that's what I'm going to be doing on the daily time frame. Nothing else. It just provides an overall picture of what the market is doing. The next thing is I will go down onto the 1 hour time frame, and on the 1 hour time frame, I want to look at the trends in more depth, and I am looking for two things, very important things: support and resistance. That's what I want to know on the 1 hour time frame. I want to know if we're approaching support or are we approaching resistance. That is all I do in the 1 hour time frame. It will just give me an idea of whether the market is retracing, consolidating, reversing, or continuing, expanding in its trend. So that's all I do on the 1 hour time frame. Right, nice and simple, nothing too complicated. Next thing I do is I will go down onto the 15-minute time frame, and in the 15-minute time frame, I am looking for two things. So I am looking for liquidity sweeps and I am looking for liquidity voids. So essentially, I want to know if the trend is approaching a liquidity sweep and if the trend has made a liquidity void, right? And that's all I do. I just mark out the liquidity sweeps and the liquidity voids. And nothing else. That's all I do on the 15-minute time frame. Next, I go down onto the 5-minute time frame. So in the 5-minute time frame, that is where mostly I carry out all my trading, and as most day traders probably do, they either use the 5-minute or the 15-minute time frame. And in the 5-minute time frame, I am looking for three things, right? I am looking for order blocks, I am looking for fair value gaps, and I am looking for break of structure. And these three things will give me confluence when I come to place a buy or a sell. Awesome. So yeah, that is basically my trading strategy. First, I go onto the daily time frame to get daily bias and understand whether we are looking for buys or sells. Secondly, I will go down onto the 1 hour time frame to get an overall idea of what the trend is doing and whether we are approaching support or resistance. Then I will go down onto the 15-minute time frame to look for any liquidity sweeps or liquidity voids. And the last step would be to go down onto the 5-minute time frame to mark out all the order blocks, fair value gaps, and breaks of structure. Now, along with this trading strategy, I also like to use two very important indicators. I don't know if you would call it indicators, but essentially they're very well known. They are called the Fibonacci retracement. I don't know if that's how you spell Fibonacci retracement, but that is Fibonacci retracement. You probably are aware what it is. And the other one is the Gantt box. Now, with the Fibonacci retracement, I am only interested in three things. I am interested in equilibrium, and I am interested in optimum entry point, or OET. I don't know what the abbreviation is, but I'm going to spell out optimum entry point. And I'm also looking to see whether the candlestick closes above this level, which is 0.718 or 81, something like that. So that is what I am looking for, those three things: equilibrium, optimum entry point, 0.718 or 0.781, whichever way those numbers, right? And now with the Gantt box, I am looking for two things. With the Gantt box, I am looking for supply and demand. So are we in the supply zone or are we in the demand zone? Is the price currently overpriced or underpriced? And that's all I want to know when I use the Gantt box. Now you might be wondering, how do I use the Fibonacci retracement and the Gantt box within my structure? And it's very simple. I will come and show you exactly how I do it. But that is basically my trading strategy. So it consists of 4 steps along with 2 very important indicators, Fibonacci retracement and the candle box. Apart from that, there is nothing else that I use to be able to analyze the charts when I am day trading. So I hope that helps. By any means, if you have any questions as to any of these terms then you are welcome to look them up. Otherwise, leave them in the comments. Okay guys, so I've given you an exact layout of my trading strategy. Now, as always, take it with a pinch of salt and do not copy it. This is not financial advice by any means whatsoever. So this is exactly what goes through my head when I am trading and what I am looking for before I place a trade, and then how I use my trading strategy to place that trade. Awesome. So as always, we start on the daily time frame just to get daily bias. And as you can see, we are currently bullish, right? So the market is making higher highs and higher lows, and we are currently in an uptrend. Nothing else to see here. It is the daily time frame. I am not looking to place a trade on daily time frame. This is just to give me an overall picture of where the market is going. As soon as we do that, and that doesn't take more than maybe 10 seconds at most, we will go down onto the 1 hour time frame. So on the 1 hour time frame, I am looking for support and resistance. That's what I am looking for. So I am just looking at support. I do not mark anything on the charts at the minute. I just look at it and I look, okay, so this is the area of support. So perhaps you would mark it out, perhaps you wouldn't. I personally don't mark out, but this is what I would say is an area of support. And then currently this would perhaps be an area of resistance up here. That's why I would think it's an area of resistance, currently making a resistance up here in this key area. And then there is support down here in another key area, right? But on the 1 hour time frame, I do not mark out anything. All I do is I go in, I take a look at it, and you can just take a look at it and you can see which areas are support, which areas are resistance, and you do not need to mark it out. You can just tell by looking at it. Great. So yeah, that is the 1 hour time frame. So now we go down onto the 15-minute time frame. Now I haven't traded today. Today is Friday, and I don't usually trade on a Friday because it tends to be a sort of a quiet day. However, I am going to be demonstrating to you how I trade and why I place certain trades. So then we go down onto the 15-minute time frame, and on the 15-minute time frame, I do start to mark things out. So on the 15-minute time frame, I am marking out firstly liquidity sweeps, secondly liquidity voids. Now, liquidity sweeps. So I just use the horizontal ray, and as you can see, there's a liquidity sweep there. And then there is a liquidity sweep here. And there is also a liquidity sweep here. And here. Now, if you're not aware of what a liquidity sweep is, then I would suggest you do some research on it. However, to give you a brief explanation on what it is, basically a liquidity sweep is where the institutional traders, the major banks, and all the big players try to push the price higher. So for instance, up here, or lower, for instance, down here. And basically all they're doing is hunting for retail stop losses. They're wanting to take that liquidity off the market to fill in their orders, right? That is basically, in simple terms, for a liquidity sweep is. However, if you've never heard of the term, I would definitely suggest you go ahead and take a read and do some research on it. Okay, the next thing I would probably look at is a liquidity void. And you might be wondering, what is a liquidity void? A liquidity void is basically where the market has created a massive imbalance. So basically, a liquidity void is mostly where there's just been either sells with no buys, for instance here, or there's been massive buys with no sells, for instance here, right? And that is basically a liquidity void. So in a sense, what I'm saying to you is that a liquidity void is created when the market is imbalanced. But the market will be looking to rebalance that imbalance, if you know what I mean. So the market will always rebalance itself, right? So for instance, here there was a liquidity void, a massive liquidity void, right? And then what the market did was say, okay, so we've created a massive imbalance. we're going to have to rebalance that at some point. So what it did is it went up here and rebalanced itself out. If you know what I mean, it's so hard to explain. But yeah, definitely consider doing some research if you don't know what liquidity void is. So that's what I look at, right? Liquidity voids and liquidity sweeps. Now, because it is Friday at 5 p.m. in the UK, the market is about to close in 4 hours. So there is not much volume going on. So there is nothing much that we can trade off. However, what I'm showing you is what I am looking for and how I use my trading strategy when I am trading. So perhaps if this is a Tuesday morning or if Wednesday morning, something like that, then yeah, definitely you will be able to see more of a setup. So right now, apologies, there is not much of a setup. So I'm just trying to show you as best as I can my trading strategy, right? Now, in many occasions, I do not actually mark out the liquidity voids. And the reason for is that they are very easy to see. The only thing I do mark out is the liquidity sweeps. The liquidity sweeps just give me a clear idea of where the price might be targeting, whether it's these highs up here, or whether it's this lows down here, or this low down here, or even this low down here, right? That's essentially why I mark out the liquidity sweeps. Okay, so that's essentially what I do on the 15-minute time frame. Now, if we were to go down onto the 5-minute time frame, this is where I mostly carry out all my trading. On the 5-minute time frame, I am looking for 3 things, as I've told you guys before. So I am looking for fair value gaps, order blocks, and breaks of structure. So I tend to mark out all the fair value gaps. So there's a fair value gap right there. As you can see, there's a fair value gap right there. As you can see, right, then there's also a fair value gap up here, and there you go. And there is also a small fair value gap here as well. If you can see, very small fair value gap here. Right, and as far as marking out the fair value gaps, and I am only interested in the fair value gaps that have happened recently. So I'm not interested in the fair value gaps down here, and I am certainly not interested in the fair value gaps up here. I am just really interested in the fair value gaps that have happened recently. Now, I could also mark out an order block. For instance, there's an order block up here, and I could also mark out a break of structure. However, break of structure, it's not necessarily marking out. You can just tell by looking at it. So a break of structure has happened here. So this is a break of structure where the body of the next candle has actually closed below the wick of the previous candle. So that's what break of structure is. There's 3 confluences that I have marked out on the chart. Now you might be thinking, okay, but how does this all go together? So what I am looking for is see how this market see how the wick here has reacted of this liquidity. So essentially what I would be thinking is basically going all the way either to this fair value gap here or to this order block, and then we'll probably be looking at placing a sell. And then I would be looking at placing a sell and targeting either this fair value gap or this fair value gap. So yeah, that is essentially what I would be looking at doing. So if I went short, also I'm not going to go short, this is just hypothetical, but if I went short, I would be looking at the market to retrace up to this fair value gap, see how it reacts. Because if this fair value gap is invalidated, in other words, it becomes an inverse fair value gap, and that would perhaps tell me that the market wants to push higher. We'll also be looking at how it reacts at this order block here. So this order block, let me just write a different color so you guys can see. There you go. So I would be looking at seeing how it reacts at this fair value gap and at this order block, because currently what we're going to see, we see a double bottom. There's a double bottom here. Now, I do not trade really using double bottoms. However, I do know they exist, and they're not really part of my confluence as such, but there's 2 double bottoms there. And usually what happens with a double bottom is the market will be pushing higher. So if anything, I would be looking at waiting to see what the market is going to do. So what's going to happen here? Probably, do not quote me on this, but probably next week, the price of gold could be pushing higher. Or to be honest, probably going to be in the next 2 hours, we could see the price get pushed higher, either to this fair value gap or to this order block, and then perhaps get rejected and then come down to either one of these fair value gaps here and then get rejected and then perhaps push higher. So that is essentially what perhaps could happen. Again, I am not saying that's what's going to happen. Again, like I said, do not rush into trades. If anything, you want to be patient. So see if the market wants to come up to this fair value gap or this order block. Take out some liquidity. Perhaps we might see the market take out some liquidity up here. And if it does, then that would be a good position to place a sell. So for instance, if you were to place a sell here, because it's rejected off the fair value gap, then you would be looking at placing your stop loss just above the liquidity high and then potentially targeting this fair value gap or this fair value gap or even this fair value gap. Again, you want to keep your risk management in place. So for instance, when it does get to this fair value gap, please close at least 30% of your position. We do not place a trade if our conditions are not met. Now you might be wondering, is this a retracement? Is this a reversal? Or what is it, right? So you can always use the Fibonacci retracement. You draw it from the low, because obviously we're in an uptrend. You draw it from the low to the high. And then again, you're only interested in these levels, 0.5 optimal entry point, which is 0.618. And the other one is 0.786. So these are the three levels you are interested. Now, why are you interested in these three levels? So 0.5, so that is basically equilibrium. This zone up here is what I would like to call the premium zone. And then anything below 0.5 is the discounted zone. 0.618 is the optimal entry point because that is basically where the market will be looking to come down to. So as you can see, there are two fair value gaps. One is just above the equilibrium and the other one is just above the optimal entry point. So that is essentially roughly where you would be looking at entering if you are going to be looking at entering a buy. Again, use this with other confluences. Do not use this on its own by any means. Please do not use this on its own because it is not strong enough to tell you whether it's going to be a buy or a sell. And then why am I interested in 0.786? The reason why I am interested in this level here is because if you see that the candle comes to this level here and it closes below 0.786, there is a strong indication that this is a reversal and not a retracement. It would only be a retracement if you see that the market bounces off optimal entry point or equilibrium. That is when it would be a retracement and the market will continue in its trend. If the market does not continue in its trend, then you would know that it is a reversal because it's got down to 0.786. And that is most likely, it will give you a pretty strong indication that it is going to be reversing. So rather than continuing in its uptrend, it will be coming down and completely reversing into a downtrend. Again, do not place a sell just because it's reversing on the Fibonacci retracement. Just use this with other confluences. The other indicator, if you like, is the Gann box. So with the Gann box, it's very similar to the Fibonacci retracement. So again, you would draw it from the low to the high. And with the Gann box, I am only really interested in knowing two things. Are we currently overpriced or are we currently underpriced? You can use the Gann box to actually know whether a fair value gap is going to be, you know, when you mark out all the fair value gaps, like for instance, there is a fair value gap here, there's a fair value gap here, 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 and then you're thinking to yourself, well, which one of those is the market going to bounce off? And the best way to know which fair value gap the market might bounce off is that the fair value gaps that are below equilibrium and that are currently lower. For instance, this fair value gap is a lot stronger than this one, and this one is a lot stronger than this one, and so forth and so forth. So the lower the fair value gaps, the stronger they are, and the more chance they have of the market bouncing off them. Again, the Gann box is only really there to give you an insight as to whether you are overpriced, in which case are you looking for a retracement and then looking to place a buy as soon as the price has come down and hit one of these fair value gaps, or is the market currently underpriced? So yeah, essentially that is what I use the Gann box for. Do not overcomplicate it, please. There is no need to overcomplicate any of these things. And as always, try and keep it as simple as possible. And I think that is as far as, you know, my trading strategy goes. As always, if you have any difficulties understanding what any of these terms mean, then drop it in the comments. And if you'd like me to make a video explaining more in depth about each of these terms, then by all means also leave it on the comments. And I hope you found it useful, and I hope you understand how a trading strategy can be formed and how it can be implemented in the markets. I'm going to show you my trades that I placed this week and exactly how and why I've been placing those trades. So as you can see on the 5-minute time frame, there are my liquidity sweeps that I marked. If we go up onto the 15-minute time frame, you can probably get a better picture. So for instance, this week I have placed 3 trades on gold. So you have it as I placed one here, then another one there, and another one here. Now some of the trades I deleted, but these are the ones that I left. So those are the ones that I am going to show you. Awesome. So as you can see, I tend to mark our liquidity sweeps. That is basically how I trade. So there's liquidity sweep there. Then there's quite a few liquidity sweeps up here that I marked as well. Right, so as you can tell, right, on the 15-minute time frame, liquidity sweeps. The purple boxes are most likely going to be fair value gaps. So that is most likely what I've marked out. So there you have it. So there are the fair value gaps that I marked out on Thursday, the 17th of October. So you might be wondering, where is my stop loss? The reason why there is no stop loss is because as soon as I saw the trade move in my favor, I moved the stop loss to break even so as to cover my position. So in case the market does want to reverse, then I will be taken out and I will not be losing any money. Probably several reasons why I placed a buy. So firstly, as you can see, liquidity sweep, pretty simple, nothing much to explain. Secondly, liquidity void. Market created a massive liquidity void. And as you know, that is an imbalance that the market will be looking to rebalance. So that's another confluence. Third confluence, break of structure. So we saw a break of structure. And as soon as I saw a break of structure, I was definitely looking towards placing a buy. And then the fourth confluence was an inverse fair value gap. So as soon as I saw this fair value gap was disrespected, then I was looking at entering the market and placing a buy. Now, probably my stop loss was below this fair value gap. I'm not going to lie. Again, I do not remember. So do not quote me on this, but I think my stop loss might have been below this fair value gap somewhere around here with a 1-3 or maybe 1-4 risk to reward ratio. Now, as always with my positions, I do tend to close at least 50% of my position as soon as the market moves 50% in my favor. And then I tend to move my stop loss to break even so as to cover myself in the event of anything happening in the market. So this is one of the trades that I took. Let's have a look at another one. Now, by no means are my trades winners. As you can see, what sometimes tends to happen is that my trades are actually winners in the long run, but in the short run, they tend to be losers. So what I mean by that is, let me show you, where did it go here? So what I mean by that is, in the long run, my trades will tend to be winners, but sometimes I get stopped out. So on this trade, on this occasion, I got stopped out down here. So I just genuinely hate it when things like this happen, because you know the trade, you've analyzed it well, you've placed your stop losses, I always like to place my stop loss as tight as possible, but then I think to myself, well, what happens if I get taken out and then the market moves in my favor? So yeah, definitely, played out in our direction, we just got taken out too early. But this is a perfect example, right, I would say, of how the institutional traders are hunting or looking to take out all the retail traders to provide that liquidity for the stop orders, for the buy orders, for the sell orders, whatever, right? So as you can see, it took out my stop loss. Perhaps it took out a lot of retail traders' stop losses, and then the institutional traders pushed the price higher. So it's just a perfect example of how the big banks, play a big part in how the price and how the market moves. Right, let's have a look at the other trade that we placed. This one was placed the 24th of October, so that was yesterday. So this one was the one that allowed me to pass my funded account. So if you guys don't know, I've actually passed my funded account. So let me show you why I entered there. Well, forget that all of this was there, right? Forget that my stop loss got hit. Forget all of that. I entered here, exactly here, because this was yesterday, so I remember it very well. Now, I drew out the fair value gap. I also drew out the liquidity sweep here, right? And then I saw that the market, how many times the market rejected off this fair value gap. So you can see once, twice, and then when it was, it was the third time I entered. So I thought, okay, well, fair value gap has been respected, bash entering. There was also a break of structure, further confirming my trade. And then as soon as I came down here, you see why there is a green line. Basically, this green line is showing you where I took 50% of my profits. And then I should have probably moved my stop loss to break even, but to be honest, I did not move my stop loss to break even. So I left the trade running. That was big fail on my part. I did not move the stop loss to break even. So definitely something to remember, to always remember, when you're trading. And as you can see, right, the market took liquidity again and came back down. And then here I closed 50% or 50% of my position. So that's basically, I had closed about 3/4 of my position. So I only had 1/4 running. And again, I did not move my stop loss to break even, which is another major mistake that I have made. But again, essentially we did get taken out. But yeah, this basically happened yesterday. So we placed a nice sell. We managed to make some profit here. But that's essentially how I trade, boys. There is nothing else. Nothing else. Obviously, I do tend to use fundamental analysis as well. And with fundamental analysis, there isn't such a thing as being able to trade with fundamentals. And the reason is because we are not institutional traders. We are not big banks. We do not have a lot of cash. So there is a few websites where you can look at some fundamentals if you like. So the most common one would be called Forex Factory. You probably are aware of what Forex Factory is and how it works, right? Most traders know what Forex Factory is. So for instance, today, Friday, 25th of October, as you can see, there was quite a few news coming out from the UK. Have obviously the Japanese yen, then the euro, the USD today did quite well, to be honest. Obviously exceeded the forecast. So that's always good to see. So that is basically fundamentals. If there's a yellow folder, it means that it's not high impact. If it's an orange folder, it means it's medium impact. And if it's a red folder, it's telling you that's going to be high impact news. But yeah, that's basically how I use fundamental analysis. So for instance, in the United States, if the non-farm employment change was coming out at 12:15 p.m., then I would not be trading at 12:15. I do have any positions open, then I will be looking at closing them before 12:15, just so that the news does not affect my positions. Yeah, and that is one of the websites that you can use for fundamental analysis. The other one is called Bar Chart. Bar Chart is pretty good for fundamental analysis as well. So for instance, you can select commodities, you can select Forex, EFTs, stocks, futures, whatever you're trading. So if I was trading gold, then I will go here and then I will be looking for metals or gold. And then what it does is it gives you a good insight as to how gold is performing, not necessarily gold itself, but how the US market is performing, because as you know, gold is based on the US dollar. So it just give you an overall picture of how the US market is performing. And then you can use that, if you like, to understand how the market could be reacting today. But then again, read it with a pinch of salt, because this news came out probably yesterday, or actually an hour ago, and the market will be closing in 4 hours. So again, just another tool you can use if you like to read some fundamentals, I guess. But yeah, boys, that is essentially my trading strategy. I've shown you exactly how I use it, and it's basically how I've been profitable on my funded account. So I hope that's provided you with some guidance and some help. As always, please do not copy my trading strategy word for word or step by step, and always try and make up your own strategy with the things that work best for you. Yeah, but as always, have a good one, happy trading, and stay safe.